now to our next conversation. According to the World Bank, small and medium-sized enterprises in sub-Saharan Africa face a huge finance gap of $330 billion. Funding is key for the survival of these 40 million companies, which account for about 60% of jobs in Africa. And digital lenders in Africa are moving to close this gap. Well, joining us now is Femi Iromini, CEO of Money Africa, is joining us right there from VI. Great to have you on the program.
Thank you very much, Lani.
Yeah, so quite a big gap, you know, there. How can it be realistically bridged?
Essentially, you can't talk about bridging the gap without talking about where does it stem from, right? And then in reality, if you had to drill down, the figure you're talking about is a lot more than that. You're going to check that, you're going to notice that even credit to GDP ratio is a lot more than 17, 18% compared to other developing countries where you have South Asia for like 37%, Latin America like 47%, right? And the reality is there's so many fragmentation. How do we even assess credit? The first level is around identity for businesses. It's really hard for you to actually verify this particular business is based in this location. Now, the other part is data exchange. How do I even know this business has the capacity to pay back the loan when I can't access their bank statement? And the biggest part is, how do you make sure they pay back? So the sense around you not having recourse infrastructure in place, a lot of businesses feel, okay, when they do something, they can just get away. It makes it really hard for lenders to be able to trust them, right? Now, when you have to think about, okay, how can we bridge the gap? The first level has to do with the identity part. How do I even verify this business is what they say they're doing, right? And the other part is being able to have access to their data, right? And the third one is creating an infrastructure around the recourse, right? As a lender, I'm very sure that when I give up loan, I have a protection in place where I'm very sure I'm going to get the money back. And to a very large extent, those were some of the things we've been able to develop at Money with our model around community-based lending. The sense is very simple. In a situation where you don't have infrastructure like other developed countries around recourse, around identity, right? What we've done is actually build on the old age system when it comes to community, social trust, and being able to leverage on that, it makes it easier for us to be able to assess their identity. And apart from that, being able to provide a recourse model in place for them to be able to have access to loan. And this has actually helped in terms of supporting small businesses across Africa.
Right. But are digital lenders still, you know, using that shaming style, you know, accessing contacts of, you know, most of these lenders and, you know, messaging them, telling them, okay, this person is owing so and so amount. Is that still in practice? And do you see it still happening?
So it's something we're very much against, right? It's not decent, right? And to a very large extent, of recent, I saw in the news that regulators are cracking up on them. There are better ways for you to actually make people to pay back, right? And the interesting thing for us is being able to create an ethical way for you to actually recover your loans back, right? Shaming people, it doesn't mean they're going to turn out to be a better person in paying back, right? It's not ethical. And to a very large extent, when we put our voices together, regulators also they're putting in their good works to make sure these practices are not actually obtainable when it comes to financial service space.
Quite interesting. But some analysts are of the opinion that, you know, many SMEs fail to secure loans because they are unable to provide, you know, key information about their businesses to lenders. You know, you're a player in that industry. What's the real solution here?
So I'm going to pick like four routes, right? The first thing is around identity, right? It should be easy for me to register my business as a small business owner. right? When I'm able to register my business, when the lenders are able to verify, it makes it easy for them to put an identity to it. Now, the other part is around data exchange. I should be able to provide my statement of account, my transaction history to lenders easily. And that is where the concept around open banking is going to help a lot, right? The other part is being able to create a model around recourse. When I know that if I don't pay back, there's a recourse around that. It puts me in shape to be able to do the right thing, right? And essentially, all this boils down to being regulators being able to provide infrastructure that supports that, right? And essentially, regulators working with the operators, it makes it interesting. I'm sure there's been a couple of policies around that they're trying to push, but the next part is actually enforcement, right? If there's an infrastructure in place when it comes to verifying identity thoroughly, or even setting up your business across board, and then when there's a model around you being able to provide access to your transaction to your statement, and the last one is when the recourse is there, it's easier to make loans to be more accessible. It's easier to support small businesses more, right? And the other part is around being able to protect creditors as well, right? Creditors, they have to be protected, but the first level is being able to provide access.
Right, but let's look at traditional banks now. Are digital lenders, competition to traditional banks, or do they complement the service?
So I'll think of the relationship as complementary, right? It's not a competition. The goal is to make small businesses to be more fruitful, right? And the more the number of players you have in the space, the more it makes it interesting. So talking about the digital lenders and traditional, it's a complementary role, because everything is towards being able to enable small businesses to be able to access loan. But the question is, digital lenders have been able to take it a step forward where they make accessibility easier. Gone are the days that you have to wait for like a month or two to be able to access loan. If you have the right documentation in place, your identity is good and all, within the space of 2 days or less, you can actually access loan. And the interesting thing we've done with money is such that within 2-3 hours, you can actually have access to loan on the platform.
Right. Thank you so much, Femi Romini. Well, it remains to be seen how digital lenders actually step up and bridge this funding gap we have with SMEs in Africa. Thank you so much for coming on the program, Chief Executive Officer, Money Africa. It was great having you.
Hey, thank you very much.
And compliments of the season.